Hello, everyone. Hopefully, you're having a good day. My name's Andy. My channel's Finding Value. Today, we're going to rip through Twitter again, see what people are talking about, see what new information there is. I did post some uranium stuff. I'm going to go over that in the beginning of the clip that I posted on Twitter. We're going to be talking about wealth building, different commodity sectors, and financial topics that hopefully support your life in becoming a wealthier, healthier individual over time. So let's dive in here. I'll give you a bunch of my financial opinions as we go through this. And again, if you want to follow me, it's at finding_finance, or you could join our finding-value.com. We do have a discount going on called discount. That is the coupon code. And we have a 5 p.m. Mountain Standard Time Sunday question and answer session that's coming up. So let's dive in to the post here. I've got my uranium squeeze post. It says uranium looks great against a lot of different sectors. So we look at this URNM versus the CRB index. Look at this thing rolling on higher here. It looks fantastic, guys. You throw a trend line through here, it's breaking to the upside against the commodity index. You price it against the energy service companies. It's bouncing off this support zone. You've got a falling wedge, broken out, and we're ready to rip to the upside. We've got uranium versus REMX. Now, REMX has pulled back recently, and URNM has gone up. So it's the combination of those two things. So URNM priced in uranium or rare earth metal shares is drastically higher. So you're making a whole bunch of purchasing power gains against REMX. This is a clear breakout. Then you got URNM versus the S&P 500. It has increased quite a bit these past few weeks. This is a weekly candlesticks, and hopefully this thing can break to the upside, and we absolutely demolish the S&P 500 in terms of purchasing power. It says when you think oil and gas equities are strong, you forget to and you forget to look at the uranium sector. So URNM priced against XLE. This looks like a breakout, guys. URNM looks absolutely fantastic. Then we've got URNM versus XOP. XOP is another very strong sector, and it's holding its ground against URNM at the moment. So XOP is also an excellent one to look at, and I think energy in general is probably going to make a big move to the upside. What does that mean? It means that XOP and URNM, for ETFs at least, they could run in stride together. It could be a dual cheater run coming up here with uranium and with energy, nat gas, oil. Stock markets. I know there's a couple of spots that people don't look at. I'm trying to bring some light and shed some light to these spots. Iron ore looking strong and could perhaps break higher soon. Good for dry bulk shipping. We've got the 3-hump consolidation, the 3rd hump, and then sometimes we break to the upside here very soon. I do think that this would be good for dry bulk shipping. Now, look at the lows here. To 2016, the lows keep creeping up. They keep creeping up. This is a very strong pattern because it consolidated and still held the increasing higher lows. So I am positive, or I like dry bulk shipping. I think there's some good companies over there. They pay some pretty good dividends. And if iron ore can break out here, perhaps it's a good entry point. Scrolling down, we've got Finding Value Finance, another one I posted. Stock markets. Fertilizers might be in a good spot to accumulate. We will probably move sideways for a little bit a while before heading back higher, but it is cheap and is close to the support level. If you draw a trend line across through here, we're very close to that retest. So we did a full retest, and I think we'll probably bounce sideways for a little while. That's generally a good location to be looking and accumulating shares in companies. The fertilizer companies also look like they are done going down for some of them, not all of them, but for some. And they could be at good accumulation points at cheap prices. So that'd be another one to look at, and that's urea ammonium nitrate, UAN. Stock markets, oil price. So downtrend perhaps, downtrend broken perhaps in the short term. Uptrend continues, question mark. So we've got a nice little downtrend on the short term that's been broken here today. So that's looking good. Bigger picture view, this is the big downtrend that we've broken, and that's that little line that we were focusing on. So hopefully we got a new move in oil developing that we can move to the upside for oil. Silver, another one I posted. I wouldn't get caught sleeping on silver here. Looks primed to go if yields allow it. We've got the lows are coming on up. We've got the blue trend line that comes from, it's reaching from way back. And we are breaking to the upside again. So silver, I think, is positioned very well for a big move to the upside. So that's one to look at. We've got URNM and URNJ for uranium still looking good. We've got the clear breakout, and this thing still looks fantastic. Same with URNJ. We've got the breakout, the retest, and then boom, here we go. We're kind of mid-stride here, so hopefully we can get a big move out of URNM and URNJ. Is this the beginning of what we call wave 3 or the third leg? I sure hope so. That's what I'm going to say. I sure hope so. Scrolling on down, another trading house has been stung after buying a cargo supposedly containing nickel that turned out to be full of near worthless steel scrap. What the heck's going on there, guys? So another metals trader says he's been hit by a nickel fraud. QE Infinity says Powell continued, we are in a position to proceed carefully. Even with more favorable inflation numbers, process still has a long way to go. 2 months of good data are only the beginning. It seems to me like they're talking pretty big. They're talking hardball here. They want to continue to increase interest rates. And the problem is when they increase interest rates, it's still stimulative with the deficits and the money that needs to be created to basically cover the interest payments on the debt. That's still somewhat stimulative. So interesting there. SRS Rock report, $80 oil in the shale industry, gutting drilling rigs, LOL. U.S. oil rigs fall by 8, Permian -7, and Eagle Ford -1. This decline in oil rigs is not due to efficiencies and 3-mile laterals. The shale industry, we're going to need much higher oil and gas prices. That's interesting there. There's the rig count going down. Interest expense on the U.S. federal debt is now at a record about 20% of U.S. government revenue. This is well above the 16 or 17% seen in the 2011 debt ceiling crisis. As interest rates soar, interest is now one of the U.S. government's biggest expenses. At current rates, within 10 years, interest expense will account for 25% of the U.S. revenue. If borrowing continues at its current pace, U.S. debt would climb from $32 trillion to $140 trillion by 2050. What is the long-term game plan? And this is your interest payments as a percent of revenue rocketing higher with those interest rates going up. And that's what I mean by it's still somewhat stimulative. That money comes from somewhere. It just doesn't come out of, poof. Well, it does come out of poof, thin air. Dario raises a good point, but the chart really needs not commit the crime of a dual axis to make the point. Here it is on one axis. So this is the 12-month inflation rate as measured by the Consumer Price Index. It is following a very similar path to the 1960s, 70s, and early 80s. Are we going to get another big inflationary surge that comes up at some point very soon? This looks like it's a pretty good match, and we'll see. One thing I will say that's different is this top and how it rolled over was driven by the commercial banking system. Same with this one. So we went into a housing boom and then a bust in housing, and then another housing boom and a bust in housing. That's what created these waves. There was another boom and bust back here too. It was a big three. This was a smaller one over here, but there were three waves of boom and bust cycles in the housing market. And it's aligning like this, but the housing market's not the driver of it. This could have been the stimulus money boom. This was 2016, 17, 18, and we came back. The 2020 bottom, then another big move, and then we'll probably get some other stimulus or I don't know what QE that comes after this. Nvidia getting whacked again today. What's that down about $70 from Wednesday's all-time highs, right? Rugged. And the one thing I'll say is, I know a lot of people are looking at Nvidia. I know they want to get sucked into this stock. It's got momentum. Ooh, it's shiny. It goes up. The risk reward here, I don't know, guys. It is very expensive. I don't like buying expensive things. And another thing is we could be going and entering a period which is very inflationary, another wave, so to speak. And technology stocks don't like that. They don't like increasing interest rates either. So we're going up in interest rates. We could hit another wave of inflation, which I think is likely. And these companies that are tech companies that a lot of people are drawn to may not do well under those market conditions. That's all I'll say there. Peter Schiff, during this Jackson Hole speech, Powell admitted that the Fed still has a long way to go to achieve its 2% inflation target. That's a gross understatement, as a full-blown financial crisis will ensue long before the target is hit, forcing the Fed to raise the target above 2%. So what I'll say here is they have to talk big, guys. I mean, they really don't have the power to just lower inflation to 2%. So they're going to raise rates most likely to some ungodly high level. They're going to break something, aka the full-blown financial crisis. And what they're going to have to do is reverse course. And when they reverse course, that's what's going to perhaps, I'll say, have another surge in inflation, because when they do QE, when they lower interest rates, when they do something like that, we very well could see a move higher in inflation when they do that. I also think that the housing market could go higher if they were to lower interest rates to save certain portions of the economy. So that's really where it's getting hit there. The Fed is prepared to raise rates further if needed, at a time when manufacturing activity is contracting at the deepest level since 2020. Higher for longer is not sustainable for the U.S. economy, especially with U.S. government debt running at historically elevated levels. So again, like I said, higher for longer, the increasing of interest rates, and how that's going to, aka destroy manufacturing activity in the economy. It's going to put a lot of stress on the economy, and I think they're going to reverse course, but who knows? So you're left with high inflation, which is stagflation if the economy contracts. Stagflation is where you have inflation going up or remaining elevated at the same time that you are destroying the economy. And that's what they're going to run into, and I don't know what the response will necessarily be. Peter says, how can Powell give a speech about inflation and ignore the elephant in the room? The primary driver of inflation is soaring federal budget deficits. Despite his claims of Fed independence, Powell refuses to criticize the President of the United States. That ensures the inflation problem will get worse. Yeah, it very well could be. Kelly says, if a $5,000 bill was due today, could you pay it? Yeah, I could easily pay it. What you can do is you can give yourself like 3 layers of protection. Your first layer of protection could be you charge it on a credit card. And what that will do will give you another month to save up money to pay off the bill. So yeah, you could pay $5,000 on a credit card and just pay it off at the end of the month if you want to do that completely. If it's a health bill, you put it through insurance. Your insurance will lower that potentially, or if you have a high deductible and let's say you have to still pay $5,000, you could take that $5,000 from a health savings account. So you could have $5,000 from there. You get that bill, no big deal. Another thing you could do is charge it to the credit card, take your money out of the health savings account eventually and pay off the credit card and net the 2% cash back. I do it all the time, guys. Another thing you could do is you just pay it in cash if you've got an emergency fund. Okay, you've got an emergency fund, no big deal. Or what you could do is put it on a credit card bill and use the dividend payments that you're getting on a monthly basis and allocate some of that dividend to pay off the bill if you have dividend income. Another thing you can do if you have good credit and whatnot is you can open up a new credit card with a 0% APR. And that's generally good for 12 months or maybe 18 months or something. You put it on a 0% APR card that you open up, throw it on the $5,000 on that, and then have 0% for 12 or 18 months. That's another option that you can do. Another option that you could do with the $5,000 bill is, I'm trying to think what else you could actually do. You could get a loan for it if you really had to. Get some sort of loan, but that's really what you're doing with the credit card. So those are some options that you could do. You could sell some precious metals if you had to. I could cover a very big bill, guys. I've got a lot of layers of protection. I've got the health savings account stacked. We've got, I could open up, put it on the credit card if I had to. I could sell precious metals, physical metals. I could use dividend income. I could set up a payment plan with the person as well if you want to do a payment plan and see if they would accept that. I would ask the person, could you delay the bill? Would you be okay if I could pay it off in 30 or 40 days? There's a whole bunch of options that you could do negotiating when you could pay it. So nothing is really set in stone here. You could maybe even install a payment plan if they're willing to do it, which could be good. You could do all sorts of that. You could set up a payment plan, pay with a credit card, and then get the 2% cash back and then pay it off at the end of the month. There's a bunch of things that you could potentially do. The inverse correlation gold versus USD can be strong shorter term, but longer term, it is not an issue. Recently, we've also seen the precious metals ignore USD's rise while being themselves at the lows, a good sign. Next big leg up in gold is brewing. Get prepared. I agree with this, and I think silver would be the better play because it looks absolutely fantastic. Platinum is also good too. And these all look absolutely fantastic for a big move. So when this ratio moves up against the dollar, I think we're going to, or when the dollar falls, I should say, gold's going to do very well. Eric Nuttall, the willful turning a blind eye by the U.S. towards Iranian sanction. Enforcement this year has one primary goal: lower oil prices heading on into the next election. Despite Iranian exports by 340,000 barrels per day year to date versus 2022, we still see global oil inventories ending 2023 at an 8+ year low. One thing that's kind of interesting is if you look at this is like a shoulder, a head, and another shoulder, and a breakdown of the neckline coming downward in terms of inventory. Weirdly enough, the oil charts all are inverse of this. They're inverted head and shoulders, which is just interesting, I thought. This is your silver to gold ratio here. This is the reverse. So he's got silver versus gold, not gold to silver. He says this has a cleaner pattern, and this chart is ready to deliver a historical up move for precious metals. Do not miss this. This is the shakeout. This is the bull flag that we've got. And this is the wave 1, wave 2, wave 3, wave 4, wave 5. We're also seeing those waves across the entire commodity complex. They are especially apparent in energy. Uranium is going into leg 3, I think, right now, and so is about silver. This is going to get. This is where the everything commodity rally could potentially occur, and this is where the big moves occur and happen. And remember, this is a ratio chart where silver is going to outperform gold and could go to a very low ratio or very high ratio in this instance, where the silver 1980 top could be. We hope. This is the last time the SPX lagged a 1% loss the day after a 1% gain. Was 316.17, which happened after the March low on 313. So this does look like a head and shoulders top, and that we could get a move to the downside in the S&P 500. So we got that there, and that's where I'm going to end it, guys. So that's what we've got for today. Give me a thumb up for the content. Hopefully you guys enjoyed it. We do have a Sunday, 5 p.m. Mountain Standard Time, question and answer session coming for the Platinum members. So that's what I've got. I don't really have any other comments, and we'll catch you guys on Sunday. See you later. This is Finding Value.